Hello, this is Mijun from Jushiran University in the United States. It's Saturday, June 28th, and Mijun Broadcasting is starting now. These days, I think there are probably a lot of people who have been looking forward to the weekend. As always this week, Chief Executive Officer Kim In-jung, a member of the Mijun family, has joined us. Hello, Chief Executive Officer. Yes, hello, Chief Executive Officer. This is family Kim In-jung. Thank you. First of all, I want to apologize for arriving so late to the broadcast again today. Since Monday, we've been offering a 50% discount on choice stock, and maybe because it's a lifetime discount this time, so many people are participating. So I'd like to take this opportunity to briefly greet the new members who will be with us for life from now on.
Yes, I'm very grateful that so many people have newly joined us as members and subscribed to our service through this first ever lifetime 50% discount event. Even though this is just the beginning, we will continue to provide solutions through this service to help you improve your investment skills and knowledge. We will keep developing everything you need, step by step, so that you can use our service without any inconvenience. We will do our best. Thank you. But sometimes some people have asked us, what about the existing users? For those who are already using the service, if you cancel and switch, there might be penalties or cancellation fees. So if possible, just leave it as it is, and when the next payment is due, everything will be updated automatically without any extra application process. Since the 50% discount is applied for life, don't worry. You don't need to cancel and reapply this time. Just keeping your current plan will probably be the best option for most people. And now, the textbook we're filming today is for the United States Stock Elementary School series. We promise to send you all the materials from week 1 up to now, compiled together as a textbook file. So there are already people asking about it. This textbook will include everything up to the material used in today's video. So on July 3rd, after our event ends, the next day, which is the day we'll be doing a live broadcast with the Chief Executive Officer, we'll send out links via push notification to our members so they can download the materials. So if you go to the post and download it, you can get all the video portable document format files from week 1 up to now. We've combined everything into a single file. If you go into the video archive and review everything again from episode 1, it will be very helpful in expanding your investment skills and knowledge. And I also brought some really surprising and great news. A service that we've been working hard to develop is finally launching. Internally, we call it Apple Youth for now. It's the Apple Youth Meta service, but you might wonder, why is it called Apple? It's called Edgar Flash because it combines AI from Edgar and Flash, as in breaking news. Internally, we shorten it to Apple and say we're developing the Apple service. So this Edgar Flash service is scheduled to launch around July 10th. So when the official earnings season begins in the United States, we're planning to launch our beta service, and we're currently finishing up the final preparations. The benefit of this service is that if you set your favorite stocks with a heart on our TwiStock platform, whenever there's an earnings flash report like an 8K from Edgar, we'll not only write an article about it, but also provide a 3-line summary below that will include our consensus data and other relevant information, combining everything into one comprehensive article. So it will be delivered with a different level of quality compared to simply translating the disclosures. So for those of you in Korea who were uncomfortable with English, you're probably worried about when to check the reports and things like that. Once this Edgar Flash service launches, you'll probably be able to receive all notifications as push alerts, and receiving these notifications is completely free. We've expanded our servers and infrastructure this time so that even members can receive notifications without much delay, and we've also invested in hardware to make this possible. So even if you're a free member, if you watch this video, you should go ahead and install the app in advance. It's available for both Android and iPhone. So for the stocks you really want to get breaking news about, you just need to mark them with a heart for your favorites. Then whenever something comes up, you'll be able to receive real-time push notifications about the performance of your favorite or owned stocks. So I think this will be a very helpful service for all of you.
This is amazing. So when a disclosure is released, it means it will be translated and summarized for us, right?
Yes, everything will be rewritten as an article. Some disclosures are very long and some are short, but we summarize them into an article format so you can see everything on a single page. Then we combine it with our consensus data, dividend-related data, and so on to include information on how things are progressing. We're finishing up the process to make it as comprehensive as what most economic journalists would write.
Personally, I'm really looking forward to it as well. Especially during earnings season, the United States stock market closes at 9 post Meridian United Kingdom time for me. After that, I sit right in front of my computer and keep waiting. When will it come up? But in the case of NVIDIA, there's often a delay of about 20 to 30 minutes. So sometimes with NVIDIA, I just wait for about 30 minutes ready to go.
That's right. When
Will the earnings results come out? But from now on, there won't be a need for that. Yes,
you can receive notifications.
I think so. That's good. From now on, you'll receive all kinds of disclosure news about the stocks you invest in. For example, if dividends are paid, earnings results are released, or there is some big news. Like a merger or an acquisition, that's right.
Whenever there's a merger or acquisition, or if there's a risk related to regulations or corporate governance, a disclosure is made, right? Those kinds of things.
Even things like that.
All of that is included and disclosed.
It's really amazing to see such constant progress. So it hasn't even been a year since I met Chief Executive Officer Kim In-jong, but working together has really pushed me to challenge myself as well. I thought I'd been living my life very diligently, but seeing Chief Executive Officer Kim In-jong made me reflect a lot on myself.
If I fall behind like this,
I realized that I can't let this happen and that we need to develop the Mijiwan channel even more. It really makes us think a lot about that too.
because there are subscribers on the Media One television channel who support us and request features, we actually get a lot of motivation from that. So thinking that we should quickly do this together for everyone is actually making us develop things faster behind the scenes.
And that's how it feels. I feel really proud. Now it's time to proceed with the American Stock Elementary School session we've prepared for today. Last week, what I remember is that while we were talking about the income statement, we wrapped up by saying that the cash flow statement shows the parts that can't be covered by the income statement.
Then cash.
It seems like we're going to talk about the cash flow statement, so please go ahead with what you've prepared for today.
As you mentioned, today's topic is the cash flow statement. This cash flow statement is the third financial statement that appears in our financial statements. So, in our first session, we covered the balance sheet, and then we moved on to the income statement, where we reviewed things like company risks, profits, the difference between operating profit and net profit, and so on. Now, this is the last one among the financial statements. So now we're looking at the cash flow statement. I think if we cover it this session and maybe the next, we'll have finished all three of the main financial statements. So once we finish this, I think you'll be at about a 5th grade level, at least in elementary school. So if there's anyone who doesn't quite understand, I gave you the textbook file earlier.
Please download it
and go through it again from the beginning. If you review it again, I think you'll be able to see things much more broadly when analyzing companies later. Today is the time to cover the most basic and fundamental part of the cash flow statement. So there will be some theoretical parts, but I'll explain them as simply as possible. If you found the cash flow statement difficult until now, I hope this will be a good opportunity for you to finally understand it and move on. Here's the first question for today. Why do we even prepare a cash flow statement? Previously, in our first session, we learned about the balance sheet and the income statement. So, knowing how assets are used and how money is earned seemed enough, which might make you wonder why we even bother preparing a cash flow statement. Back in the days of Graham and earlier, there was no cash flow statement. The focus was mainly on the balance sheet, and the income statement was just 3 lines: sales, operating profit, and net profit, and that was it. But over time, the income statement became much more detailed. And as for the cash flow statement, it didn't exist at first, but people realized it was necessary, so it was created. The reason the cash flow statement came about is because this particular problem arose. As the Chief Executive Officer mentioned earlier, profit and cash are different, so even if the income statement shows a profit, in reality, the company might not have enough cash, which could suddenly lead to bankruptcy, a large-scale capital increase, or issuing bonds. These kinds of things can damage shareholder value. The cash flow statement was created to check those kinds of issues. So the cash flow statement, along with the balance sheet and income statement, remember, I mentioned in the first session that financial statements are documents that record a company's business activities. Specifically records only the actual cash that comes in and goes out during those business activities. So even in the balance sheet, there are items where cash comes in and goes out, and the same goes for the income statement. The cash flow statement is a document that takes those cash inflows and outflows from both statements and organizes them all together in one place. You can think of it like this for now. So since the cash flow statement is mainly about cash, we say that it's based on the cash basis and the statement of financial position. For the statement of financial position and the income statement, once a transaction occurs, we record it as it happens and enter the amount. But even if the amount is recorded, there can be a time gap until the money actually comes in. So the cash basis in the cash flow statement means that if cash doesn't come in, it's considered as if it hasn't happened. But for the statement of financial position and the income statement, even if the cash hasn't come in yet, as long as a transaction occurs, it's always recorded. So because of that difference, the cash flow statement is written based only on actual cash. So to put it simply, I'm not sure if students these days still keep a cash book when they get their allowance.
But for us,
Back in our day, when we got our allowance and we had to write down how much we received, how much we spent at the stationery store, and so on, and then record the remaining balance. Actually, that's what we call a cash flow statement. It's a document that only records cash income and cash expenses. So that's the basic concept you should keep in mind. So why do we need to analyze the cash flow statement? There are about 4 key points, and this is a very important part. Most investors focus on the income statement and don't really look at the cash flow statement, but truly skilled investors spend much more time analyzing the cash flow statement than the income statement. And there are also many books published about analyzing cash flows. That's why when it comes to analyzing cash flows, I think there are about 4 main points. The first is that you can quickly filter out companies that might go bankrupt even though they're showing a profit. In other words, a company may look profitable on the income statement, but suddenly go bankrupt or have to raise a large amount of capital. The first advantage is that you can filter out those kinds of situations. The second point, which is probably even more important than the first, is this. You can also avoid companies that are engaging in accounting fraud. This is the same idea. There are cases where companies don't actually have cash coming in, but they inflate their profits on paper. Based on that, they issue stocks at high prices or do similar things. So even in Korea, there have been quite a lot of cases like that. Even though cash flow isn't coming in, they inflate their income statements, accounts receivable, or inventory assets to make it look like the company is doing well. Then they raise capital at a high price, but since the real value isn't there, the stock price drops and investors end up losing money. Cases like this do happen. So if you look closely at the cash flow statement, you can avoid a lot of these kinds of companies. It's very important in terms of avoiding risk. Third, it's also important for determining whether a company can increase its net profit. When we divide net profit by the number of shares, we call it earnings per share. The reason is that there's a difference between the cash that actually comes in and the accrual accounting shown on the income statement. There's a time gap. When a company starts making a lot of money, cash increases first and then the income statement catches up later. So if you see that cash from operating activities on the cash flow statement is starting to increase a lot, but net profit is still much lower than that, there's a good chance that net profit will eventually increase to the level of operating cash flow. I'll explain why that's the case by looking at the details of operating cash flow a bit later. So what you need to remember here is, first of all, operating activities. Companies whose cash flow from operations is greater than their net income, for example, 2 or 3 times more, are likely to see their net income increase to that level in the future. That's how you should look at it. So it's useful for finding those kinds of companies. Next, lastly, it's also very useful for discovering early stage growth stocks. As I mentioned during the Choice Stocks investment recipe session on discovering growth stocks, it's extremely helpful for identifying early stage growth companies. Because early stage growth stocks usually have negative net income, but their operating cash flow turns positive first. So since you can identify companies that turn profitable early on, it's very useful for discovering early stage growth stocks, even if they're currently running at a loss. So these 4 reasons show why we must understand the cash flow statement and why it's worth analyzing. Now, there are three types of cash flow that investors absolutely need to know. So as an investor, you only need to understand these three. When I talked about the balance sheet and income statement, I also told you to just remember certain key points. For the cash flow statement, you only need to remember these three types of cash flow. First, to warm up, let's think about what kinds of cash flow exist in our personal lives. If we apply that to a company, the flow is exactly the same. That's why I asked this question first, because it's a great way to help you understand a company's cash flow statement. The first is salary or business income. If you work at a company, you receive a salary, and if you're a sole proprietor or run a corporation, you generate business income. This is actually the most important basic income for employees or sole proprietors. This is something that shouldn't be unstable. This needs to support you, and everything else should be additional. If you don't have this and try to make a living with just the extras, it would be very difficult. Next, the second is investment income through financial techniques, which can bring in cash for individuals. So, through things like interest, dividends, and in the case of real estate, rent, cash can flow in. We can describe this as investment income through financial techniques. Then the last type of cash flow is what we call financial activities. For example, if we take out a loan, cash will come in. Next, if you receive a gift from your parents, money will come in as well. These kinds of cash inflows and outflows can occur, and for individuals, you can have these three types. If someone doesn't have the first one, only has the second one, and doesn't have the third one, what should we call that person? They don't have earned income, they don't have primary income, but they have income from financial investments and no income from financial activities. These people are probably full-time investors.
Someone who has lost their freedom.
That's right. I think we could call them that. So you either live without this or you go all in on it. It's one of the two. On the other hand, if you don't have this and you don't have any investments, but you only have this, then I think it would be a life of extremes. You'd either be unemployed or your parents would be wealthy enough that you could keep receiving money from them, something like that, right? But honestly, the healthiest thing is to have all three of these. That's the best. But if we look at our lives independently, this is what fundamentally needs to support us the most. Based on that, the income you earn from watching content like these videos or through Medium television and managing your finances, and then later, any additional income you might get from gifts or inheritances, these three can usually be seen as an individual's cash flow, and it's the same for companies. So when we move on to companies, just remember these three types of cash flow. First, the income related to salary and business, which I mentioned as primary income for individuals, is profit for companies. Net profit, and operating profit are cash earned from a company's core activities. That's why cash flow starting from net profit is very important. What do we call that cash flow? We call it cash flow from operating activities or cash flows from operations. In English, it's called cash flows from operating. It's the cash flow that comes in through operating activities. So this is the most important cash flow. So when analyzing a company's activities, you need to analyze the cash flow from operating activities in the cash flow statement. There's actually not much else to analyze in the rest. For the rest, you just need to check whether cash came in or went out. When we talk about analyzing the cash flow statement, it basically means analyzing the cash flow from operating activities. Second, a company makes these kinds of capital investments for growth, whether it's investing in tangible assets or buying servers, things like that. Or if the company has a lot of cash, it can buy marketable securities like bonds, MMFs, or various other marketable stocks. The reason for buying these things is that the company invests in order to generate cash later on. So we call this activity investing activities cash flow. So you can understand that investing activities are done for the future growth of the company. You can define operating cash flow as the cash flow that a company earns through its main business operations. Investing cash flow refers to the cash used for activities that invest in the company's future growth. So you can see that cash as investing cash flow. The third one is similar to personal loans or raising funds. When a company borrows money, we call it a loan. So that's how they raise funds. There are only these two ways a company can raise funds, by borrowing or by other means. They can do it through borrowing, and of course bonds are also included as a form of borrowing. Here, when we say capital increase, it means that we've increased something. Increase means we've made it bigger, and capital means we've increased the company's capital. So capital increase isn't a difficult term. If you increase the company's capital, that's what a capital increase is. A paid-in capital increase is when the company increases its capital by receiving money from shareholders. A bonus issue is when the company increases its capital without receiving money from shareholders and gives out free shares. That's how it works. So the terms themselves aren't that difficult. So activities that raise funds in this way are what we call financing activities or cash flows from financing. So to sum up, the cash a company earns through its business is called operating cash flow. The activities for investments needed for growth are called investing activities. And if the company needs more funds and has to raise money, the cash flow related to that is called financing cash flow. That's how you can organize it. So from now on, when you think about cash flows, remember there are three types: operating, investing, and financing. If you can explain what each one is in a single sentence like I just did, you can say you've grasped the basic framework of the three most important types of cash flow. So even after this video ends, I think it would be good for you to review and memorize at least this much. Based on this foundation, the rest of cash flow statement analysis and how to interpret operating cash flow will branch out from here. So I hope you'll definitely keep these three things in mind. I'm sure those of you listening to Mijuin TV and Mijucho will be able to memorize this much. And
You mentioned this once a few weeks ago, right? So since this is a review, you probably remember the three types of cash flow. Then now,
let's take it one step further. Actually, this is one of the most difficult parts today, and it's also a very important part in understanding the cash flow statement. I won't be covering operating activities, cash flow, investing, or financing separately, but next time I'll talk about what the signs for each should be. I'll mainly explain with real-life examples from the growth and maturity stages, focusing on how you should interpret the cash flow statement in practice. Today, I'll focus on explaining the theory, and then on our website, I'll actually open up a cash flow statement from a real company to show you how it's structured and how to interpret the changes that have occurred. When someone asks what operating cash flow is, it's important to understand the concept itself first. Earlier, I mentioned that this concept is not a definition. I already explained the definitions of operating activities and cash. In reality, what this means is that net income is recorded on an accrual basis, meaning it's recorded when a transaction occurs. What we're doing here is converting that net income to a cash basis. Operating cash flow is different from net income because net income isn't actually cash. So it's the process of adjusting net income to only include the actual cash transactions. The result of that process is the operating cash flow. So if you look at the statement of cash flows for operating activities, you'll see that at the top, the formula is generally divided into four main parts. It starts with net income for the period. Why does it start with net income for the period? And then, as I mentioned earlier, net income is not cash. So the point is to convert this net income into cash. How much is it if you only count the actual cash portion? That's what calculating cash flows from operating activities is about. So the starting point is always net income. You probably understood up to this point, and then these three things are usually where people raise their hands when studying. It's pretty difficult and the terms are a bit tricky, but I'll briefly explain each of these and then I'll go over the actual details of these three things one by one in more detail. The first one, like plus, means that you add it to the net income, and minus means that you subtract it from the net income. The plus or minus in front means that depending on the change, it can either be a plus or a minus. That's how you should interpret it for now. As for the sign itself, then the first thing is you add back non-cash expenses, right? This concept is already difficult, but when you look at Korean financial statements, it gets even harder. I've written this in short form again. It says adding back expenses with no cash outflow. So cash itself is hard and cash outflow is also hard, but then on top of that, you add back expenses with no cash outflow. This makes things really complicated and people tend to give up thinking, this is too difficult. But I'll explain it in an easy way. Adding back expenses with no cash outflow. I've used this phrase, but you just need to remember the most representative example. Here, you just need to think of depreciation expense. There are a few other small amounts, but they're not significant, so you can just forget about them. The main thing is understanding what depreciation expense means. If you think carefully about why we add this back, you'll probably understand that, of course, it makes sense to add it. I'll explain it to you one page at a time. First, let me explain depreciation expense. Simply put, depreciation expense means recognizing the cost of expensive assets over several years. That's what we call depreciation expense. So let me give you an example. And told you I drew a picture here. Let's say we built a factory worth 10 billion won. Now let's assume the useful life of this factory, the period during which the company can make money from it, is about 20 years. After that, they'll have to build a new factory. This year, since the factory is getting old, let's see what actually happens. You invest 101 in cash, so you pay out 101 right away to build a factory. That's an outflow of 101 in cash. But on the other hand, what increases? You now have a factory, right? That's an asset. When I talked about the balance sheet, I mentioned that it would be good to remember current investment, tangible, intangible assets. So you need to remember this when trying to understand things like this. That's why it might be hard to understand. Then you can go back to week 2 and review it again. So in Tangje to Yumu, we said that tangible assets are assets you can see. That's why on the financial statements, the tangible assets of the factory increased by 10 billion won. So cash is used and tangible assets increased by 10 billion won. That's basically how it's structured. But let's say 1 year has passed. After a year, the useful life is now 19 years left. 1 year has been reduced. So since you're using 10 billion won over 20 years, if you divide it, about 500 million won disappears each year. The value decreases. And this 500 million won is what we call depreciation expense. To put it simply, it's kind of like an installment plan. You swipe 10 billion won at once, and then you pay back 500 million won each year for 20 years. That's what it means. So it's hard to understand depreciation expense. Then think of it like a credit card installment plan. Of course, the contract is different, so you shouldn't go around saying it's exactly a credit card installment. But if you think of the concept as being similar to a credit card installment, you can understand it as splitting up the payments and paying them over time. So the depreciation expense of 500 million won is reflected. And where does this go? Since it's an expense, it goes into the income statement. The 500 million won is entered just like that. So what happens is the 500 million won depreciation expense is reflected as a cost and deducted in the income statement like this. But what about cash? Did 500 million won in cash actually go out or not? In this case, it didn't go out. Because earlier, the 10 billion won was already paid out in the first year. This is just an accounting procedure where 500 million won is depreciated each year as the value drops, and it's treated as an expense, but it doesn't mean that cash actually went out. You understand up to this point, right? Then you've got the concept of depreciation expense down. If another year passes, then it becomes 18 years and depreciation expense will occur again. So you reflect another 500 million won as an expense, but still there's no cash outflow. So as I mentioned on the previous screen, depreciation expense is involved in the process of converting net income into cash from operating activities. That's why depreciation expense was deducted from net income. The amount deducted is the depreciation expense. But in the cash flow from operating activities, there was no cash outflow, right? So you have to add back the amount that was deducted in order to get the cash flow from operating activities. If what I'm saying is difficult to understand, just repeat this part about 3 times.
You just need to listen to it.
I think so. I'm telling you this because you shouldn't miss it. So depreciation expense is like the installment plan I mentioned earlier. So just because 500 million won went out on the books, it reduces the expenses on the income statement. But the cash didn't actually go out in the cash flow, right? So you have to add back the reduced amount to create the cash flow from operating activities. So the typical non-cash expense, which is depreciation, is added back in. That's the first thing to understand about depreciation. Next, the difficult term addition of expenses without cash outflow. In simple terms, that means depreciation. And addition here means you add it back in, you increase it. So as long as you understand the concept of depreciation correctly, you'll know exactly what that term means. Then what happens if you make a large-scale facility investment? The company originally had about $20 billion in tangible assets, but suddenly this year they invested an additional $20 billion in tangible assets. What do you think will happen? The unit depreciation expense,
Significantly.
there will be a situation where it rises more than twice, right? If it rises more than twice, what happens to the net profit? It will decrease, right? As the net profit decreases, people will think, this company's net profit margin is getting worse. This isn't good. I shouldn't invest. That's how it can be interpreted. But this company has something like this, you know. It's just like when we crouch down for a moment to make a bigger leap. The net profit shrinks for a while, but when these assets are properly connected to sales later, it's about building the strength to jump more than twice as high. The part where you can get a hint about that is operating cash flow, and you can find clues through depreciation expenses. That's how you should understand it. This part,
Since this part is a bit difficult, I think it would be good if I give you one more example so you can fully understand before we move on. Last week, I also told you an interesting story. General managers usually stay at one hotel for about 3 years at most, and then move on to another hotel. Then a problem arises. The problem is that there are various facilities and equipment inside the hotel that require investment. For example, refrigerators need to be replaced every 10 years, and things like cookers or cars also need to be replaced. The cars used to transport guests also need to be replaced with newer models every few years to maintain the service level, and large-scale equipment needs to be purchased as well. There are many expenses, but the general managers receive incentives. So at the end of each fiscal year, bonuses are given based on how much net profit they make. Then, from the general manager's perspective, if they're at this hotel for 3 years, they would want to minimize costs and increase revenue throughout those 3 years to get as much bonus as possible. But the problem is, if they focus only on their own interests like that, the hotel's facilities will keep aging and the service quality will inevitably decline. So the hotel will lose competitiveness compared to others. So what they came up with was to divide the costs into 2 categories. One is the general operating expenses, which are the business expenses, and the other is something called CapEx. CapEx is the capital expenditure I mentioned earlier, and this investment in facilities does not go into the profit and loss statement, or P&L. If I bought a new large machine or replaced a car or expanded the hotel to add 20 more rooms for the future of the hotel or to improve its services, when I make such a huge investment, I handle the expenses separately so that it doesn't affect the net profit I generate. This is called CapEx, but since CapEx also involves spending money, it will show up as money spent in the cash flow. But the problem is, at some point, you have to record this spending on the income statement, and the process of recording it as an expense is what we call depreciation. So, for example, if you buy a new car and plan to use it for 5 years, and the car costs 50 million won, then you should calculate it as spending 10 million won each year. And you can think of that 10 million won as depreciation expense. So on the cash flow statement, if you buy a car for 50 million won, it's recorded as spending 50 million won only in the first year. But on the income statement, you don't see the 50 million won. At first, it's not recorded at all, but from the second year, 10 million won, 10 million won, 10 million won, and 10 million won are continuously recorded as expenses. But in reality, all the cash was paid in the first year. So these 10 million won amounts weren't actually spent, but they appear as if they were, so you have to add them back. I think it would be good to understand these 10 million won amounts as non-cash expenses.
yes, that's right. You explained it so simply that I think I understand it even better now. So investors create indicators that take those factors into account when looking at companies making large-scale facility investments, and that indicator is called earnings before interest, taxes, depreciation, and amortization. So at the end of earnings before interest, taxes, depreciation, and amortization, there's depreciation and amortization. The D stands for depreciation, which refers to depreciation expenses, and the A stands for amortization, which refers to the amortization of intangible assets. So in the end, if you add that amount back, it's like saying, let's not count this as an expense. I mean, isn't that a bit much? It's something done for future growth, and earnings before interest, taxes, depreciation, and amortization is a metric that makes you look at it this way. But earnings before interest, taxes, depreciation, and amortization is not an official account in the income statement. But for companies that make these large-scale facility investments, earnings before interest, taxes, depreciation, and amortization is used to look at things a bit differently, because otherwise aren't we seeing their profits as too small? In my opinion, if you just look at operating cash flow, you can probably see things most accurately. So even without using earnings before interest, taxes, depreciation and amortization, operating cash flow and earnings before interest, taxes, depreciation and amortization are almost the same concept. If you think of it this way, I think it'll be a bit easier for you. All right, now let's move on to the second part.
A small dream is important. Let's plant a hopeful future together, growing little by little every day. Do you feel excitement blooming in your heart? Let go of your greed. It won't be any different this time either. The result is just a continuation of the process. I'm not afraid, even if dark adjustments come. Miju, take my hand and let's go. I'll be the light for the unseen tomorrow. Happy investing, supporting each other's dreams. Let's walk together down this beautiful downhill path. Happy investing, together with Miju, until the day we all bravely and proudly retire, all together.
See you in the next video.